Most people believe the power of the United States comes from its military, its technology, or its democratic ideals, but that assumption hides a deeper truth. There is a quieter system, largely invisible, that has held the American empire together for decades even as wars were lost, industries hollowed out, and politics grew dysfunctional. This system does not rely on tanks or elections. It relies on money, but not in the way most people think. And the real mystery is why it still works at all. The dollar feels ordinary because we live inside it. We earn it, spend it, save it, and complain when it loses value. Yet outside U.S. borders, the dollar behaves less like a currency and more like infrastructure. Entire nations depend on it to function. Global trade collapses without it. Crises are measured by its strength or weakness. The question is not why the United States uses the dollar, but why the world does. This story is not about a single conspiracy or secret meeting, but about an architecture built layer by layer, often in response to disaster. Each solution solved one problem while quietly creating another. Over time, these layers formed a system so powerful that even American leaders lost full control over it. Understanding how that happened requires going back to moments of fear, improvisation, and unintended consequences. At the end of the Second World War, the United States found itself in an unprecedented position. Europe and Asia were physically destroyed, their factories bombed, and their currencies discredited. The U.S., by contrast, had expanded its industrial base and held most of the world's gold. This imbalance created both an opportunity and a risk. If global trade failed to restart, political instability would follow, and communism would spread into the vacuum. The solution emerged at Bretton Woods in 1944, where a new monetary order was designed. The dollar would be tied to gold, and other currencies would be tied to the dollar. This arrangement made the dollar the anchor of the global system without openly declaring it an imperial tool. It appeared cooperative, rules-based, and stable. In reality, it placed the United States at the center of global liquidity. This system worked because it matched the realities of the time. The U.S. produced goods the world needed, and dollars flowed outward to rebuild allies. Those dollars came back in the form of demand for American exports, cause and effect aligned neatly. But embedded in this structure was a contradiction that few wanted to confront. The world needed more dollars, but the U.S. could not supply them without running deficits. As the decades passed, those deficits grew. Foreign central banks accumulated dollars far faster than the U.S. could back them with gold. By the late 1960s, the promise that every dollar could be converted into gold became mathematically impossible. The architecture that stabilized the post-war world was quietly approaching its breaking point. In 1971, the United States severed the dollar's link to gold, effectively ending the Bretton Woods system. This should have been a catastrophic loss of trust. Instead, something remarkable happened. The dollar did not collapse. It adapted. What replaced gold was not another commodity, but a web of geopolitical arrangements that transformed the dollar into something even more powerful. The key shift was that dollars no longer needed to be backed by metal. They needed to be needed. Through agreements with oil-producing nations, global energy trade was denominated in dollars. If a country wanted oil, it needed dollars first. This created constant global demand, not because of faith, but because of necessity. At the same time, U.S. financial markets deepened and liberalized. Treasury bonds became the safest and most liquid assets on earth. Foreign governments recycled their dollars into U.S. debt, funding American spending while stabilizing their own exchange rates. The cause and effect loop became self-reinforcing. The more the U.S. borrowed, the more the world depended on the dollar system. This was the moment when the dollar stopped being merely a national currency and became global monetary plumbing. Banks settled international trade in dollars. Corporations borrowed in dollars. Crises were resolved with dollar swap lines. The Federal Reserve, originally designed to stabilize domestic finance, evolved into the de facto central bank of the world. Yet this rise carried hidden costs. Because the U.S. could borrow cheaply and endlessly, discipline eroded. Manufacturing moved offshore, financialization accelerated. Debt replaced wages as the engine of growth. The empire no longer needed to conquer territory because it controlled settlement, credit, and liquidity. The breaking point did not arrive all at once. It arrived in chunks. The Latin American debt crisis, the Asian financial crisis, and the dot-com collapse each exposed fragilities. Each time, the response was the same: more liquidity, more dollars, deeper dependence. Every rescue strengthened the system while increasing its long-term instability. The most revealing stress test came in 2008. The crisis originated inside the U.S. financial system, yet when markets froze, the world demanded dollars, not alternatives. The Federal Reserve created trillions in emergency liquidity, much of it flowing to foreign banks. This revealed the true architecture. Global stability depended on a single national institution acting beyond its mandate. Instead of weakening U.S. power, the crisis expanded it. Countries that criticized American excess still relied on the dollar to survive. Attempts to diversify reserves continued, but no substitute offered comparable scale, liquidity, and legal predictability. The system bent without breaking, reinforcing the belief that it was inevitable. The fallout, however, reshaped politics. Inequality widened, trust eroded, populism surged. The benefits of the dollar system accrued to asset holders and financial centers, while costs were socialized through austerity and inflation. The architecture held the empire together, but it hollowed out parts of its foundation. In response, policymakers attempted fixes that treated symptoms rather than structure. Regulation tightened in some areas while leverage migrated elsewhere. Interest rates were pushed to zero, then below. Quantitative easing became permanent. Each fix assumed the same premise: that global demand for dollars would always absorb the consequences. Geopolitically, sanctions weaponized the dollar system. Access to payment networks and reserves became tools of statecraft. This demonstrated the system's power, but also its vulnerability. Every use of the dollar as a weapon encouraged rivals to imagine a world without it, even if they could not yet build one. Efforts to create alternatives multiplied. Regional payment systems, bilateral currency swaps, digital currencies, and commodity settlement experiments all promised change. None replaced the core architecture. They reduced friction at the margins while leaving the center intact. The failed fixes revealed how deeply the system was embedded. Today, the patterns are repeating with higher stakes. U.S. debt levels dwarf those of earlier eras. Global trade is fragmenting. Interest costs are rising. Yet during every shock, from pandemics to wars, capital still runs toward dollars. This is not confidence, it is structural dependence. The shocking data lies in the scale. Over 80% of global trade finance is denominated in dollars. Most foreign exchange transactions involve the dollar on one side. When funding markets seize, the Federal Reserve remains the only institution capable of restoring liquidity at speed. No rival system has demonstrated this capacity. History suggests that monetary architectures do not collapse overnight. They decay, adapt, and persist long after their economic logic weakens. The British pound retained global influence decades after Britain's industrial dominance faded. The same inertia now supports the dollar, even as the underlying economy strains. This leads to three unavoidable takeaways. First, U.S. power today is monetary before it is military. Second, the system survives not because it is fair, but because it is indispensable. Third, every expansion of its use increases the consequences of its eventual failure. The warning is not that collapse is imminent, but that complacency is dangerous. Systems built on trust and necessity can flip quickly when alternatives reach critical mass. History rarely announces turning points in advance. It reveals them only in hindsight, after assumptions have already broken. The open question is whether the United States can reform the architecture it depends on without losing the advantages it provides. Managing decline, if that is what lies ahead, requires acknowledging the system's limits rather than denying them. Empires fall when they confuse durability with permanence. If you want to understand the future of geopolitics, markets, and your own economic security, you cannot ignore the plumbing beneath the headlines. The real story of power is written in balance sheets, settlement systems, and crisis responses. If this perspective challenged your assumptions, consider subscribing, sharing this video, and continuing the conversation about the forces that quietly shape the world.